The reasons behind Vodafone's decision to cut jobs and how it affects its employees and customers. Vodafone, one of the world's largest mobile operators, has announced that it will cut 11,000 jobs worldwide over the next 3 years. This is part of a €1 billion cost-saving strategy that aims to simplify the company and improve its competitiveness. But why did Vodafone decide to take this drastic step? And what are the implications for its workers and customers? According to the new group chief executive, Margherita Della Valle, Vodafone's performance has not been good enough in recent years. The company has faced several challenges, such as rising energy bills, inflation, regulatory pressures, and fierce competition from rivals. Vodafone has also seen its share price slump to a 2-decade low, and its profits decline in the last financial year. Della Valle said that Vodafone must change to deliver better service and value to its customers. She said that the job cuts will affect both its headquarters in Berkshire, UK, and its local markets around the world. She did not specify which countries or regions will be most affected, but said that the company will try to minimize the impact on its employees. She also said that the company will reallocate resources to invest in new technologies, such as 5G and fiber broadband, and to enhance its customer experience. She said that this will help Vodafone grow its revenues and cash flow in the future. But what does this mean for Vodafone's customers? Will they see any benefits from the company's restructuring? Vodafone claims that by simplifying its organization and cutting out complexity, it will be able to offer more reliable and consistent service to its customers. It also says that by investing in new technologies, it will be able to provide faster and better connectivity, as well as more innovative products and services. However, some analysts have warned that Vodafone's cost-cutting plan may not be enough to turn around its fortunes. They say that Vodafone still faces significant challenges in some of its key markets, such as India and South Africa, where it has struggled with regulatory issues and competition. They also say that Vodafone may face resistance from unions and regulators over its job cuts, especially in Europe, where it employs about 40% of its workforce. They say that Vodafone may have to offer generous severance packages or negotiate with local authorities to avoid legal disputes or social unrest. In conclusion, Vodafone's decision to cut 11,000 jobs is a bold move by its new chief executive to simplify the company and improve its performance. However, it also comes with risks and uncertainties for both its employees and customers. It remains to be seen whether Vodafone can successfully execute its strategy and achieve its goals. Vodafone is one of the world's largest telecommunications companies, with operations in more than 20 countries and over 300 million customers. However, the company has been facing some serious challenges in recent years, especially in its key market of India, where it is struggling to survive amid intense competition, regulatory hurdles, and a huge debt burden. According to its latest annual report, Vodafone's revenue for the year ended March 31, 2022 was €43.8 billion, a decrease of 2.6% compared to the previous year. The company reported a net loss of €1.6 billion, compared to a net profit of €536 million in the prior year. The loss was mainly due to impairment charges of €3.4 billion related to its Indian joint venture, Vodafone Idea Limited (VIL), which is on the verge of collapse. VIL is India's third-largest telecom operator by subscribers, but it has been losing market share and money for years. It owes more than €14 billion to the Indian government in spectrum fees and adjusted gross revenue (AGR) charges, a levy based on a percentage of revenue from telecom services. It also has another €10 billion of debt to banks and other creditors. VIL has been unable to pay its dues on time and has repeatedly sought relief from the government and the courts, but without much success. VIL's financial situation has spooked investors and customers alike, who have been switching to its rivals, mainly Reliance Jio and Bharti Airtel. These two companies have invested heavily in expanding their network coverage and offering cheaper and better services to attract and retain customers. As a result, they have increased their revenue and profitability, while VIL has been bleeding both cash and customers. According to the latest data from the Telecom Regulatory Authority of India, TRAI, VIL had 253 million subscribers as of June 2021, down from 281 million a year ago. Its market share dropped from 27.6% to 23.6% in the same period. In contrast, Jio had 431 million subscribers and a market share of 40.1%, while Airtel had 352 million subscribers and a market share of 32.8%. VIL's average revenue per user, ARPU, a key metric of profitability, was also lower than its competitors at 107 Indian rupees, $1.40 per month, compared to 138 Indian rupees, $1.90 for Jio and 146 Indian rupees, $2 for Airtel. The current financial situation of Vodafone and VIL is bleak and uncertain. Vodafone has written off its entire investment in VIL and has said that it will not infuse any more funds into the joint venture. It has also warned that VIL's ability to continue as a going concern is dependent on a positive outcome of its legal appeals and negotiations with the government. However, the prospects of any relief or rescue are slim, as the government has not shown any willingness to bail out VIL or offer any concessions on its dues. Vodafone's troubles in India have overshadowed its performance in other markets, where it has been making progress in growing its customer base, expanding its 5G network and launching new products and services. The company has also been focusing on improving its cash flow and reducing its debt through asset sales and partnerships. For example, it has sold its stake in Vodafone Egypt for €2.2 billion, merged its tower business in Europe with Cellnex for €10 billion and formed a joint venture with Virgin Media in the UK for €31 billion. However, these efforts may not be enough to offset the impact of VIL's potential collapse, which could have serious consequences for Vodafone's reputation, credibility, and future growth prospects. Vodafone may have given up on the Indian market, but it cannot escape its liabilities or its responsibilities towards its stakeholders. Vodafone is one of the world's leading telecommunications companies, with operations in more than 20 countries and over 300 million customers. But despite its global presence and scale, Vodafone faces some challenges in a competitive and fast-changing market. How is Vodafone planning to overcome these challenges and achieve sustainable growth in the future? According to its latest annual report, Vodafone has a clear vision to become a new generation connectivity and digital services provider for Europe and Africa, enabling an inclusive and sustainable digital society. To realize this vision, Vodafone has identified 4 strategic priorities that will guide its investments and actions. Investing in leading gigabit networks, Vodafone aims to provide high-speed and reliable connectivity to its customers, both on fixed and mobile networks. It is upgrading its fixed networks with fiber and cable technologies, and rolling out 5G built right with a focus on coverage, capacity, and quality. Vodafone also plans to leverage its network assets through partnerships, wholesale agreements, and infrastructure sharing. Driving customer engagement and loyalty, Vodafone wants to offer its customers a differentiated and personalized experience, based on their needs and preferences. It is enhancing its product portfolio with converged offers, value-added services, and digital solutions. It is also improving its customer service and loyalty programs, using data analytics and artificial intelligence. Accelerating digital transformation, Vodafone is transforming its own operations to become more agile, efficient, and customer-centric. It is simplifying its processes, systems, and structures, and adopting cloud-based platforms and tools. It is also empowering its employees with digital skills and capabilities. Growing through new services and adjacencies, Vodafone is exploring new opportunities to generate revenue and value from its core assets and capabilities. It is expanding into new segments such as Internet of Things, IoT, cloud, security, financial services, and e-commerce. It is also pursuing strategic partnerships and acquisitions to access new markets and customers. By pursuing these strategic priorities, Vodafone hopes to achieve profitable growth, improve its cash flow generation, and enhance its returns to shareholders. It also aims to contribute to the social and environmental goals of the societies in which it operates, by supporting digital inclusion, education, health, climate action, and responsible business practices. Vodafone believes that it has a significant role to play in the future of connectivity and digital services, and that it has the assets, capabilities, and ambition to succeed in this role.